I'm Ted Seides, and this is Private Equity Deals. Middle market businesses are where the real action takes place. Around 200,000 businesses in the United States fall into the middle market size range, generally defined as generating revenue between $25 million and $1 billion. These businesses collectively employ 50 million people, or almost a third of the U.S. workforce, and represent 2/3 of total U.S. private equity deal value. Big deals may grab the big headlines, but a lot of action in the economy and private equity industry takes place in the universe of middle market businesses. Season 1 of Private Equity Deals shared deals from 8 well-known GPs. In Season 2, we discussed 8 well-known companies bought by private equity firms. We can't begin to cover the massive middle market in just 8 deals, but in Season 3, you'll get a tiny sliver of what the middle market is all about.
All opinions expressed by Ted and podcast guests are solely their own opinion and do not reflect the opinions of capital allocators or their respective firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Past performance is not indicative of future results. Clients of capital allocators or guests may maintain positions in securities or managers discussed on this podcast.
On the first episode of Season 3 of Private Equity Deals, Chris Ackerman discusses TigerRisk. Chris is a managing director at Flexpoint Ford, a Chicago-based private equity firm founded in 2005 that manages $7.5 billion, targeting investments in the healthcare and financial services sectors. TigerRisk is an independent reinsurance broker and capital advisory firm founded in 2008. The company was founder and employee-owned at the time of Flexpoint Ford's investment and had grown to become the 4th largest reinsurance broker in the world, sitting below the big 3 of Aon, Marsh McClennan's Guy Carpenter, and Willis Re. Our conversation covers the history of TigerRisk and its differentiation as a preferred alternative to the big 3. We discuss Flexpoint's sourcing of the deal, perceived investment opportunity and risk, and COVID disruption to the deal process. We turn to the business performance, culture as a competitive advantage, alignment of incentives, unexpected sale, and lessons learned. Please enjoy my conversation with Chris Ackerman. Chris, thanks so much for joining me.
Thanks for having me.
Why don't we start with a description of Flexpoint Ford?
Sure. Flexpoint Ford was founded in 2005. We have always been focused exclusively on the financial services sector and the healthcare sector. I think when we started, those two sectors probably accounted for 35-40% of the economy. And so as we've evolved as a firm and as the market's evolved, I think we've realized that being a healthcare expert or a financial services expert is no longer good enough. And so we've gotten very subsector focused. So each of our partners have a couple of majors and a minor, where we take an industry like insurance or wealth management or payments and spend many, many years getting deep within those sectors and developing robust networks of industry executive relationships and investment banker relationships, and really understanding key trends and themes before the broader generalist market catches on to things. And we invest based on those themes and deploy our capital against that.
So I usually think of financial services and healthcare going together. How did that come about?
The general theme is really they're two highly regulated industries that in our minds have a fair amount of knowledge moat around them. It's hard to just dabble in healthcare or financial services because of so much of the regulatory frameworks that you're dealing with. So you need a lot of inherent expertise if you're going to be successful. And then in addition, if you think about financial services, there's a whole part of that landscape that's more balance sheet first in nature. And that is a very different style of investing where you're thinking more about book value multiples and ROEs as opposed to pure EBITDA multiples. So we like those knowledge moats. It creates a bit of differentiation for us when we're approaching the market.
So we're going to dive into TigerRisk on the financial services side. What's your style of investing before we do that?
We probably have a bit of a value lean to us. One of my partners would classify it as more of growth at a reasonable price. What the key theme for us is how do we find interesting founders and entrepreneurs in the subsectors that we care about, that we can back and put capital against with a shared vision to create value over some period of time. And so if you look across all the investments we've made in the last 17, 18 years, 75-80% of them have been founder-backed businesses where we're usually the first institutional capital into those businesses. So that's really the common theme. How do we leverage our deep subsector expertise and partner with founders in the subsectors that we care about to create value for us and them and our investors.
So let's dive into TigerRisk. What is this business?
TigerRisk is a reinsurance broker and capital advisory business. So what does that mean? What they do fundamentally is they work with insurance and reinsurance companies, and they help in very complicated bespoke transactions lay off some of the risk that an insurance company or reinsurance company might have. And so if you think about an example, a Florida homeowners insurance company takes lots of risk associated with a potential hurricane coming through. They may not have the capital to support the losses associated with that risk. And so they will turn to the reinsurance markets to hedge off that risk. And you need a broker that sits in the middle of it because there's usually many, many reinsurance counterparties that will take on that risk. And they tend to be highly structured transactions where certain counterparties want higher risk components that go for a higher price, and other counterparties want lower risk components at a lower price. And so the reinsurance broker sits in the middle, gets paid a fee to structure and advise. And so that's fundamentally what TigerRisk does and has built over the last 10 plus years.
What's the capital markets advisory portion of the business?
So it's a unique component to TigerRisk, and it's what really differentiates them in the market from some of the other large competitors that they come up against. They really take a holistic approach to advice and services to their clients. So fundamentally, their clients are the C-suite of large and mid-sized insurance companies, and they provide reinsurance brokerage services at its heart. But the capital advisory piece is really a boutique, highly specialized investment bank that can help on mergers and acquisitions, capital raising transactions, other forms of access to third-party capital that, can support a balance sheet or can support risk. And it's differentiated as the other competitors in the space really don't have access to those types of resources. It's now 15-20% of the business. They've built up an entire group of former bulge bracket investment bankers that sit within TigerRisk and work alongside their reinsurance brokers and add this element of advice that gives them, candidly, a much deeper relationship with the executives that they're ultimately trying to win business from.
What is the history of the business?
Business was started in 2008. It was started by two industry executives, Rod Fox and Jim Standard. Rod was a very successful entrepreneur who began his career as a reinsurance broker. And he partnered with Jim Standard, who was a very successful reinsurer. He was the founder of Renaissance Re, which is one of the largest reinsurers. And they really had this vision that the market, which at that point had been dominated by 3 or 4 large global brokers, they needed an alternative that provided this holistic approach that included both capital advisory and reinsurance brokerage, but also an ability to have talent inside of a reinsurance broker that could be a bit more creative than the constraints that some of the larger brokers have in place and could solve more of the complex reinsurance needs that insurers have as opposed to the standard thing. So really they viewed themselves as, let's create the special forces of the reinsurance brokerage world and out hustle and outflank large competitors by having more interesting ideas that they can bring to their clients to create value.
How did you come about this opportunity?
We like to say at Flexpoint that deals beget deals. If I go back to how we approach the market, we try to get really deep within our subsectors. I've been fortunate that I've spent the last 17 plus years looking at insurance and insurance-related businesses. I got to know the reinsurance brokerage space from one of our first deals we did in 2006, 2007, where we backed a Florida insurance company where the market was really insure the homeowners business in Florida and ultimately use the reinsurance markets to hedge that off and capture an arbitrage on pricing. And through that, I really got to understand the reinsurance brokerage space. After owning several insurance companies, what I began to see is Tiger emerging as this alternative provider to the market, where they would be much more aggressive than some of the large players at approaching us with ideas on a regular basis. We've owned a business called GeoVera for the last 11, 12 years, which is an earthquake-driven business. They also have wind exposure in the Southeast. And probably about 8 years ago, 4 or 5 years into the investment, I was unhappy with our existing reinsurance brokerage relationship. And so I used that as an opportunity to go out and meet some of the other reinsurance brokers. And Tiger really emerged as a differentiated provider in that marketplace. So after doing a full RFP and meeting the Tiger team, we realized that we wanted to give them a shot. We brought them in as a reinsurance broker. There's no better way to build a relationship with a company than actually to have a commercial relationship. And this is why the subsector expertise is so important to us. So we became a client of theirs for a number of years. I got very close with the senior team as a result of that. And from that relationship emerged an opportunity to invest in the company in 2018. And I had a conversation that involved potential minority investment where Flexpoint would take out one of the founding shareholders who was no longer involved in the business. And that emerged into a conversation where we'd provide some amount of liquidity for the other shareholders. And ultimately, we put a proposal in place. They contemplated it. And after a number of months where we had done diligence and probably gotten to the 15-yard line on a deal, we both collectively realized that they needed to go through some management transition before it made sense for us to actually make the investment. So we put things on hold. And at the end of 2019, they came back and said, okay, we're ready. And here's what the transaction looks like. It would be a modest majority investment. So we were going to buy a little over 50% of the company. One of the founding shareholders, Jim Standard, who was no longer involved in the business, was going to sell his share. And the rest of the shareholders were going to sell some modest amount of shares and roll the remaining piece, which is a very traditional style for us, buying a small control in a founder-driven business. We're the first investors into this business. And so we engaged in that at the end of 2019. The first time around, they were only talking to us. Second time around, unfortunately, they decided to talk to a couple others. The business had grown quite a lot in the meantime. It had probably doubled. And so I was being tasked with thinking about the business at a much higher valuation than I had a couple years hence, which was challenging, but I think we had a lot of conviction in the underlying players at the business and what their opportunity was in the market. And so we approached it pretty seriously and leaned in, I would say, at trying to get the deal done.
You now have at least somewhat of a competitive process. You've known the company. How do you balance the need to do the thorough due diligence with wanting to win the deal?
We had an advantage because we had already done a lot of due diligence in our prior process. We also had an advantage because we had been a client for 5 or 6 years. And so we fully understood what their service offering was and why it was differentiated. But you can't shortcut the real diligence. We did full due diligence on the business, again, quality of earnings, third-party consultants, the full works, to make sure that we weren't missing something. The business had not had debt before. They had a CFO in place that was producing monthly financials, but we wanted to make sure that the EBITDA that we thought we were acquiring was actually the real EBITDA. And so it all checked out. But we spent a month and a half, 2 months doing full diligence. We just had a knowledge advantage relative to our competitors because we had much more of a higher level of comfort having spent so much time with the company in the past.
As you did that work, what did you see as the big opportunity?
The first and most obvious opportunity was the business had done a nice job of growing. It had grown by episodically bringing in interesting talent to scale the business. I think they had felt a little hamstrung on being more aggressive at the talent acquisition side, given it was owned by the employees. And I'm not sure that the ability to take the risk and maybe even drive EBITDA down for some period of time while you're going out and hiring real talent was there. And so we set out on a plan very early on to figure out what that talent acquisition could look like and how much could we acquire in quotes to generate higher revenue and where was that talent going to come from. So that was the highest priority. This was not a consolidation play, as is often the case. This was a highly consolidated industry where most of the revenue in this industry is driven by 3 very large global brokers, and there were very few brokers to acquire. So this was all about trying to acquire talent. So that was probably first and foremost. Number 2, and this is very common for us, is this was a business that had grown very nicely under the founder's watch, grown top line, but they had never really fully scaled out their infrastructure. So while the business was north of $100 million when we made our initial investment, they needed upgrades around talent. So putting together that architecture on how do we scale the business and what's the infrastructure that we need to scale the business. The other piece, which we like to invest in businesses that have what I'll call free call options. And there was a free call option embedded in TigerRisk in that there was a rumor in the market that 2 of the largest competitors were likely going to try to merge. So Aon had been rumored to be in discussions with Willis. And had that happened, there would be potential meaningful disruption in the market, both from a client perspective. Oftentimes, a client is served by multiple brokers. And if they're served by both Aon and Willis, they probably will be looking for another third party to come in. And then more importantly, from a talent perspective, this was going to create massive disruption in the market if it were to happen. And so we loved having that free call option out there. We thought that there was a decent chance that that could happen. Lo and behold, within weeks of us announcing our deal, that deal got announced and created this massive wave of opportunity for Tiger. And so we liked having that in our back pocket as well.
And on the other side, what were you worried about?
This was a business that had grown through the founder and a lot of his relationships. So he was really important. And so making sure that we were aligned with Rod Fox, the founder of the business, and that he was committed to the long term and that we had a shared vision for growth. It's really important when you're backing founders that we're on the same page. So that was really important. There were elements of this business that had some concentration. They had some large clients that were pretty meaningful. So how do we ultimately outgrow that? And then how do you think about this capital markets business, which inherently is 15-20% of the business and not recurring? The reinsurance brokerage business, call it 85% of the business, is highly recurring. And so that's easy to value and comes at a high multiple. The capital markets business can be lumpy. As we know from investment banking, you can win more deals, lose deals. They tend to be contingent fee bases. And so how do you think about that from a value perspective? And what are the risks around that as you grow the business and scale the business?
So as you worked through that, what happened in the making of the deal?
It's never a straight line as these things go. So this is an epic journey, and a lot of private equity deals are, in that it was probably 5-6 years in the making. As I mentioned, we had this false start several years before. We finally got the deal to a point where we had agreed on terms and they wanted to move forward with us, which was exciting for us as a firm. This was in February of 2020. I remember vividly negotiating the final terms of the LOI. They have a big conference every year, a ski conference, and I was at the conference with the management team. They have all their big clients there. And obviously we were having these side conversations, and I was in the car driving to the conference with Rod Fox, the founder, and I remember him asking me, do you think this COVID thing is going to be an issue for us as it relates to getting the deal done? And I said, no, I think as long as we can get things done quickly, I don't think it'll be that big of a deal. By the end of the weekend, it turned out that their conference was a super spreader event. And I think probably 60 to 70% of their clients got COVID. And so that created massive disruption. And at the same time, we're trying to get this deal done. So we had an LOI signed. We were finalizing our diligence. We had a number of lenders, given the nature of this business, that were incredibly excited to provide us debt. It was a reasonable amount of debt that we were trying to put on the business. And within a couple of weeks, the deal got leaked. And so the press began to circle and say, TigerRisk is trying to get sold. And so there was all this pressure and anxiety on top of the fact that everyone was forced to now work at home, which none of us really understood how to use Zoom. We were lots on conference calls. And so the efficiency went way down. And before we could blink, we were a week away from signing the transaction, having finished our diligence, and the lenders politely called us and said they're risk off. And there was no market for us to get debt. And so it was an essential part of the funding of the transaction. It was probably 35-40% of the capital structure. We had to take a pause. And I remember being at home. My wife and kids had fled, given COVID. So I was home alone and on the phone on a number of conversations with the management team, in between having conversations with my partners about how much conviction do we really have in this business. And I think internally, we came to the conclusion that long-term, we have immense belief that this business is going to be successful. It's just, how do we protect our downside? Because if you think about it, the market was down 25%. Everyone was afraid. Everything had shut down, and nobody really understood what was going to happen to the economy at the time. In hindsight, it's very easy to reflect on it. Of course, everything was going to work out, but at the time, it was incredibly scary. There was a period of time where this was probably one of the few deals that got done. The upside of having a small firm, we got together and thought about what it would take for us to move forward with a transaction. I think a lot of people, their first instinct would be, well, use the blunt instrument, just lower price. You've got leverage. They probably want to get a deal done. Just cut the price 10%, 15%, and we'll feel better. The reality is, if the world blows up, that's probably not going to change the outcome. And it doesn't solve the funding need that we had with debt. So we had to be a bit more creative. We have a lot of experience doing minority deals where we'll apply some structure to those minority deals. And this all happened within 24, 48 hours. It was a whirlwind. We went back to the company. We did not change the price of the deal, but we changed the structure a bit in that we we're coming in at a more senior level so that in a downside scenario, our equity would be protected. But candidly, in any scenario where the business was worth more, none of it would matter. And so we could sell that to the management team that, listen, we all believe that over the next 5 years, there's going to be massive value created. If for whatever reason things don't work out that way, we need some downside protection in order to do the deal. But assuming everything is flat to up, everybody's going to be in the same position as we were, and we're not lowering price, which I think went a long way. And then ultimately, we had to ask the sellers, which were the employees, to take back a pretty significant seller note with the commitment that we would take that out in the capital markets as soon as it became available. This goes to trust. And had we not had a 6+ year relationship with the management team, and had they not wanted to partner with us and we wanted to partner with them, I think the deal would just have fallen apart because it was just too hard at that point. And I remember having some tough conversations with Rod where he said, listen, if it's just too hard, no harm, no foul, we'll re-engage down the road and maybe there'll be something to do. And I just had so much conviction that this long-term was going to be a great deal that I didn't want to lose that opportunity. And so let's be creative to solve this. Let's be creative together. And so over a couple of days, we worked out a new structure. And once we worked out the new structure and agreed upon it, we moved forward and signed a transaction in the midst of what was a really challenging market. Of course, as we all know, what happened next was the Fed began to cut and massive stimulus came into the economy and things got reinflated. In the meantime, within 2 weeks of us announcing, Aon announced that they were going to try to combine with Willis, which created that call option immediately before we even closed the deal. And we had a probably 6-month window between signing and close to get through some regulatory hurdles, where actually in the interim, we were able to finance most of that seller note with third-party debt. So we were able to deliver on that commitment. It wasn't 100% of it, but it was about 70% of it. And then within a couple months after the close of the transaction, we took out the remainder of that seller note. So it all ended up working the way we expected to, but we did have the downside protection if, for whatever reason, things went sideways or backwards.
I'm curious about what your internal conversation was like about that existential risk. And in a funny way, this is a reinsurance business. They're accustomed to underwriting catastrophic risk. How did you guys think about this? It's almost like a game theory.
It's completely unknown. It's without precedent, particularly in modern day. There were questions asked like, how do we know people are going to buy insurance anymore? How do we know that the entire economy is not going to go into a dramatic depression over the next 4 or 5 years? And even if they do buy insurance, it's going to be at significantly lower rates and have a meaningful impact on the business. And we had all those really hard conversations, which candidly, we had answers for some, but not answers for all. And I think what we kept coming back to was we're long-term owners of businesses, and where do we think this business will be in the next 5 to 7 years? If the business does take a dip over the next couple of years, and if you look at our underwriting case that we ultimately approved, it wasn't up and to the right. It was down and then maybe back up over some period of time. And if that were to happen, do we have the right capital structure to support that? So are we not over leveraging and overburdening the business if there are some bumps in the road? And two, over the long period of time, from a secular perspective, should this business win? And do they have the right to win in this market? And insurance is one of those things that's a pretty essential part to every economy. It's likely not going to go away. So assuming that, do they have the ability to win in a market that is relatively competitive? And do we have the skill set to partner with this management team to help them execute on that? The resounding answer kept coming back, yes, we believe that. And so let's figure out a way to get this done.
So once you own this, I'd love to roll through and see how some of these parts of your investment thesis played out. And that first, as you mentioned, this Aon Willis transaction happened. So what happened with that talent acquisition?
It was more of an opportunity than I think we ever expected. So one, we won some new clients out of the gates, and that was really helpful. But two, and it became broader than just Aon and Willis, everybody at the large brokers stood up and thought about where they want to be. We aggressively pursued them. We very quickly created a pipeline of the top 500 reinsurance brokers out there, focusing on most reinsurance brokers have a specialty, whether it's property cat or medical malpractice or liability or inland marine or whatever it might be. So who are the brokers that we know that we would like to be part of TigerRisk? I didn't coin this phrase. Rod Fox, our executive chairman did, let's use culture as a competitive advantage. So we have a very differentiated model. It is not for everybody. We're more aggressive than our competitors. We're more creative. We work harder than them. We have to out-hustle them. And oh, by the way, we also have this interesting access to equity that many of the large public folks don't have in a private equity structure. So let's use that as a competitive advantage. And I will say we were very pleasantly surprised at the receptivity we got in the market. And in a very short period of time, we were able to increase our headcount by 50%. We recruited about 55 brokers in the first 2 years of our ownership, meaningful brokers with meaningful books of business that they would bring over to TigerRisk. And we really disrupted the market. I think the sleeping giants of Aon and Willis, which is now part of Gallagher. Ironically, Aon didn't consummate the transaction because of FTC issues, but that business ultimately got sold to Gallagher. The Willis business did. We saw that in spades, and that was the biggest contributor. This was an organic growth model from the beginning, taking advantage of these market tailwinds. At the same time, growth is great, but you need the infrastructure to support the growth. And so we really needed to make sure that we had all those pieces in place. Very quickly out of the gates, we went out and we recruited a new CFO to the business. We recruited a new general counsel to the business. We brought in a very senior person, one of the top 2 or 3 people at Aon's business, to come in as our president of reinsurance brokerage. We added a couple of new spokes to our service offering to further differentiate us. We brought in a senior McKinsey consultant to have a strategy element to go along with our investment banking element. So again, this holistic solutions component. We brought in a senior person who understands the rating agency aspect, which is really important to the insurance world. And so we created a business around the rating agency advisory piece. We built all this infrastructure at the same time we were out there recruiting producers to the business that could bring in revenue. And we could provide them this backdrop of we've got all of these services that all of our large competitors have. And oh, by the way, we have all these other things that are very differentiating to us. And you get a piece of equity. That equity piece was something that they couldn't really access at our large publicly traded competitors in the same way from a wealth creation perspective that they could at Tiger.
So if you're crystallizing this idea of culture as a competitive advantage, if you're in the room with one of those 55 brokers or one of these senior people on the infrastructure team you brought in, what was the pitch to them to get them to join TigerRisk?
Yeah, and I will say Rod and Rob Radel, who's now the CEO of the business, they probably spent something like 50 or 60% of their time, and they still are recruiting. So these are not phone calls and an offer and they come over. These are oftentimes a senior person, and maybe they have some other people on the team, and there are multiple conversations that you're having over multiple months and multiple geographies. These are highly compensated, highly sophisticated individuals. You have to, one, the base is you have to convince them that our platform has the same resources and expertise that the larger platform that you might be leaving has. So you can still service your clients in the same way, if not in a better way. And 2, you have to convince them that our culture is a better culture to be in. We are more of a team-oriented culture. We share ideas across the firm. A lot of these other places can be very siloed and fiefdoms, and people are competing with each other for the same clients. That doesn't happen because we're all sharing in the equity, that those walls get broken down. And so they have to believe in that. And I think a lot of people come in from some of the larger places and they don't believe that that's really the case until they start working and people start sharing ideas and people start providing client referrals across the board. And they start seeing the value that that creates for them personally from an equity perspective. And then they get it. Candidly, the best spokespeople are the people that we recruited in because they've seen the value and they can go out and share it with all of their former colleagues at whatever firm they came from.
Insurance business traditionally on the broker side is commission-based. How do you take that model and get people to be collaborative and share?
You let them share in the underlying profits of the business. And you do that both through profit sharing. We all share in the underlying profits of the business and through equity. So if you help somebody else out, that's going to generate more revenue for the overall business. It's going to generate EBITDA and ultimately going to generate value that you will share in. Fundamentally, you can put those incentives in place, but if the culture is not there to match those incentives, where the culture has always been a we're all on the same team approach at TigerRisk, even the capital advisory against the reinsurance brokerage, we're all working in this together to try to provide the best services, the best creativity, the best ideas to our clients. And how do we do that across the firm? And so how do we pick the best people wherever they sit, whatever their expertise are, to make sure that we're providing that to our clients? I will credit this largely to Rod and the business that he's built. That culture has been embedded in Tiger since they started. So you can have the incentives, and those definitely amplify the culture, but it comes first with the culture.
When the founding team does this transaction for the first time and gets a big check, how did you go about ensuring, as you said, that the risk that Rod, who's so important to this concentrated group of clients, would stay aligned with you?
It's always a gut check that we have to do as private equity investors, particularly given 75 to 80% of our deals are founder-backed businesses where we're the first institutional capital in. We're oftentimes the first big check that the founder receives. There's a subjective bet that we're making that despite the fact that this person might be putting some money in their pocket, that they're still highly motivated and they still have that yearning to win, regardless of what their bank account might say. It's a hard thing to assess, but again, this goes back to building relationships over a long period of time. Fortunately, I had gotten to know Rod, and I knew that he's going to work until he can't work anymore because this is in his blood, this is in his DNA, and he hasn't stopped at all. That's a judgment call, and you have to make the judgment call that the person has the raw energy and the desire, and it's not all about economic incentives to drive that behavior.
So as you brought in these new brokers, enhance the infrastructure, what happened with the performance of the business?
It hit our 5-year plan probably in 2 years. We were able to just about double revenue in 2 years and more than double EBITDA. So margins improved over that period of time. We recruited a lot more than we expected. We expanded into a lot more product areas and lines of businesses, as well as geography than we expected. Some of the people that we brought in were at a level of seniority that I don't think we would have otherwise thought we'd be able to attain. And so that model really worked. And we were sitting in a situation that we had a real winner on our hands a couple of years in, much, much faster than I think we had otherwise expected.
So you got to know Rod and the team for many, many years before buying the business. You buy the business, and we're only a couple of years later, you no longer own it. So what happened?
It was unintentional, and it was a bit bittersweet as well. What happened was our success didn't go unnoticed. One of the elements of the business that we really liked from an investment thesis perspective was the scarcity of this asset. TigerRisk was really the only scaled reinsurance broker independently owned in the industry. And so if there were a strategic in the insurance services business that wanted to enter the reinsurance brokerage space, TigerRisk was really the only pure play business out there, and it had a fair amount of success and growth. And so our success post-COVID into 2021, 2022 went highly noticed across the industry. We were being very disruptive by recruiting the people we were. So lo and behold, we got a call in early 2022 from an interested party. The group was Howden, which is also backed by several large private equity players based in the UK. My initial reaction, the management team's initial reaction was, we're having too much fun. This is going really well. It's way too early. We're not interested. My management team wasn't quite as familiar with Howden. They're not in the reinsurance brokerage space. They had largely grown in Europe and most recently had come to the US, but not in reinsurance. And so they weren't as familiar with the business. So initially we said, thanks, but we're okay. And they were persistent. They were very persistent. They ultimately put a price on the table, and it became more interesting once we saw a price that we felt was a fairly compelling exit for us as investors. I still was of the mindset of, let's keep going. And I think what changed was, and this goes back to culture, was the management team spent more and more time with the management team of Howden and realized that the cultures were incredibly similar. David Howden, who started and still runs Howden, is very similar to Rod. He just has a British accent. And they got along incredibly well. And the way that they approached their business, the way that they use culture as a competitive advantage to recruit people, to out-hustle people in the market was very compelling for the management team. So I couldn't let that go unnoticed. And ultimately, they were the ones that came to me and pushed me over the edge to do the transaction because in their minds, they couldn't see another buyer that would be such a good strategic and cultural fit for the company. And to me, that's important. We were never going to sell this business to one of the large global players because it would destroy what they had built. But by putting it into Howden, where they had only a nascent reinsurance brokerage practice, it could still remain Tiger. It's now called Howden Tiger, but it could still remain intact, and that culture could still remain intact, and they could continue to execute on the plan that we all had agreed to. As I said, it was bittersweet. Ultimately, we decided to move forward with Howden. It was a compelling price. In our minds, we felt like we were probably getting a price that was a couple of years ahead if we had ultimately taken it to auction. And we were taking risk. We had grown a ton in the last couple of years, but could we continue at that crazy pace going forward? So we decided ultimately to move forward and execute on a sale of the transaction much earlier than we typically do. It was a 2-year hold for us, a little more than 2 years after regulatory approval. Most of our businesses we own for 5 to 7 years, but this was one where it made sense for us from a financial perspective, but more importantly, it made sense for our partners, the management team, from a cultural perspective.
If I'm putting the math together in my head, you mentioned more than doubling of EBITDA. What were the relative multiples when you purchased and sold?
When we purchased the business, it was a low double-digit multiple. And when we sold the business, it was a much higher multiple. Without putting specifics around it, there was meaningful multiple expansion in the business. And at the same time, I think we were able to improve margins a bit along the way. So the value drivers worked. We were able to grow top line. We were able to grow margin. And we had meaningful multiple expansion because I think the value of the business became much more understood by the market as opposed to when we invested only a short term earlier, 2 years earlier. The original purchase price was a semi-competitive process. It was not as if we bought the business for a meaningful discount to the market. It was just a misunderstood asset at the time. And as we had more and more success as the management team implemented their plan, I think it became much more understood how valuable the business was, and a strategic ultimately stepped up.
What's happened to the business after you sold?
It's continued to do incredibly well. So they've executed their plan and have hired another 30 to 50 brokers since we closed the deal less than a year ago. So they are continuing to take advantage of their strong spot in the market. There were some strategic benefits to being attached to a larger global insurance intermediary that they're leveraging. The team has remained intact and remains motivated. It's always bittersweet to sell a good business, but I always love when the business continues to perform afterwards because it means that we're investing in high quality businesses. It wasn't just time the market right and we sold it and then the next guy struggled with it. I love to see the business continue to perform. So they're doing really well, and I still am very close with them and hope that they continue to crush it as a company.
How do you think down the road with a business like this of whether you'll get another bite at the apple?
We were fortunate to have an ability if we wanted to roll some of our stake into this deal. And we contemplated it. I think the challenge for us was Howden is a very large business that has 3 very large private equity firms, and we would be a very small passive minority firm. And that's not really what we tend to do at Flexpoint. We want to be much more actively involved. And so that was a challenge. How do we leverage this into other things? There's 2 components to that. One, our relationship with Howden Tiger remains incredibly strong. I view them as a strategic partner. As I mentioned, they have this investment bank. We have bought assets from the investment bank. We also do other capital-related transactions with them. I'm talking to senior members of that team all the time to make sure that I understand what's going on in the insurance and reinsurance markets. And so the competitive intelligence I continue to get from them is really valuable. Will I be able to leverage this into investing in another reinsurance broker? Probably not. And that's a bit of the bittersweet element of this. There really aren't other businesses, at least today, of scale that we can invest in. But if one comes along, certainly would probably be towards the top of the list of rightly buyers for that business. So it does give us an advantage there. But as I said, more importantly, it's that strategic relationship that we fostered with the company that will pay dividends for us for many years to come, given how important they sit within the broader insurance and reinsurance market.
Chris, what have been your biggest lessons learned from the deal?
There's a couple. One, relationships matter. And having a shared trust with a management team is incredibly important, particularly when you go through a crisis like we did during COVID. Don't underestimate the importance of those relationships. Don't underestimate how important it is to plant seeds on opportunities well in advance. I always like to say that we're out planting seeds all the time, and 3, 4, 5 years down the road, we hope that they spring. This is a classic example of that. Stay in front of things and continue to build those relationships. Those will ultimately be important. The other thing is don't underestimate the value of culture. private equity investors often downplay the relevance of culture. It matters, particularly in human capital intensive businesses. So don't underestimate the value of culture. In line with culture, don't underestimate the value of broad equity distribution across employees to motivate a team. It's an incredibly powerful tool. We've used it across a number of our businesses that are human capital intensive, and it does drive behavior. So those are all really important lessons I think I'd take away from this.
Chris, one last question for you. What's your favorite aspect of private equity?
Yeah, for me, I think it's the people I get to interact with on a daily basis, whether it's the founders and entrepreneurs like Grod Fox that we partner with on our portfolio companies to execute shared visions of growth, or our investors that manage some of the largest endowments and foundations and capital allocators in the world and provide really amazing insights to us as a GP into the broader investment market, or the team that we've built at Flexpoint that challenges me every day to think creatively and has made me into a much better investor than I would have otherwise been. And I get to experience components of all three of those on a daily basis. So to me, that's the most exciting piece.
Chris, thanks so much for sharing this TigerRisk adventure.
Yeah, thanks for having me.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.